Welcome back, everybody. Thanks for joining us again today. We have another exciting guest, and we're just ready to rock and roll again and learn some more real estate tips and tricks that are going to help all you Canadians out there, do a little bit better every day, manage things better, and learn how to do all that stuff. We're going to get into it soon, but first, everybody listening should go over to breakthroughreipodcast.ca. You can listen to all of the 180 some episodes that we've done over the last quite a while, and you can hook up with our guests there too. So if you go into the show notes and you hear somebody that's particularly interesting, you want to know more about what they're doing, you can get in touch with most, if not all, the guests in the show notes, and they can also get our free gift, right, Sandy?
Yeah, they can get a free gift, the ultimate strategy for building wealth through real estate, which they can pick up on our website by signing up. They also, of course, get to catch up with us and everything we're doing, and stay in the loop with whatever other events or tours or excursions we might have on the go. And yeah, I mean, this show is going to be no different. I mean, there's lots of value coming. I'm excited to learn and share some great content, and I'm sure our listeners are going to take away a ton from this one. This is going to be a good one.
And speaking of current events and things like that we're going to be doing, do you have anything coming up?
That's a good question. Do we have? I know you do, so I'm gonna save me some time.
It's every time that question stumps you. It's every time.
I know. Do we have anything coming up? You know what?
You gotta at least hide it better next time I ask.
Well, I mean, we're still, of course, running our Vaughan Investors Club still, which has been really fun. We're just in our 7 months into it. Started it earlier this year. We've had a great turnout with some awesome guests and people there, and we're gonna be just looking at the dates here when this will be out. Probably our next big one's gonna be September, that people can come join us out in Vaughan area, just north of Toronto. Really easy to get access to, and we've had some awesome fun times there. We're going to do some property tours and things with that group as well. So,
now what's it called again? Just so people can look it up.
VaughanInvestorsClub.com is where you can go for all the info. And we've had tons of listeners over the years that have shown up and said they've been listening for 5+ years, 6+ years. It's been pretty cool. So, if anyone's in the GTA and wants to check that out, you are absolutely welcome.
Maybe I don't need to bombard you like that every time. Maybe they can, like you said, if they're on the mailing list, they'll know what's going on.
Well, I don't have, you stumped me because I don't have anything that's like in a different country or somewhere south and fun. And I know you do. Are you sharing that now?
Well, yeah, recently we just ramped up. So monthly I'm doing webinars on investing in Costa Rica. So if you are on our mailing list, you'll know when we're doing those. But once a month I'm doing the webinar just on the buying process, that type of thing. And then also I've been working with brokerages to share a referral program, so I can go on there with, in the training room and just explain how the referral program works and run through that same presentation with them because there's been a lot of agents that have clients that are interested in learning about that. So if anyone listening has a group or is at a brokerage and you want to get in touch with me and I can run through this presentation with you guys, then hit me up, rob@mrbreakthrough.ca. And also, we've just lined up our investor event for this year. So this year, it's going to be November 24th, 25th, and 26th here in Playa Potrero, Guanacaste. That's going to be the starting point. We're going to see some different areas, learn some things from last year's event. And actually, our guest was on last year's event, so we might talk about that for a minute. But, just going to change things around a little bit, keep it small, keep a little bit of more of a tight-knit group. And I think logistically that's going to be easier. So, if anyone's interested in that, same thing, just reach out and get yourself on the list.
So they're going to get intimate access to you and a select few of awesome investors. That's great.
I mean, it's going to be a little bit different than last time. I think the group was pretty big last time. So logistically, getting people through the properties, getting them to the properties, getting everybody fed and moved on to the next venues and all that kind of stuff was a little bit difficult. So I think if we keep it smaller, it'll be a little more beneficial for everybody.
So that's good. So people got to register now. Then I'm hearing there's not many of these seats to go around.
That's right.
Okay.
Act now.
Yeah.
I think that's pretty much it. You got anything else you want to talk about?
You know what? We've got an awesome guest standing by. We were just talking pre-show there. It's been 9 years since we've had him on. So why don't we get into that and learn from Andrew and what he's been up to?
Yeah, super excited to have Andrew Brennan back on the show. It has been way too long. I was looking through the same as you, and I thought we'd had him on twice, but I think we've only had him on that one time. So there's going to be a lot of stuff there in between. 9 years was the last time you were on, Andrew. Welcome.
Yes, it's been a while. Thank you for having me.
Yeah, thanks for joining us again. So, I mean, and since then, I know that, you know, your strategy and the way that you invest has shifted drastically. So we're going to get into all that stuff too.
Okay.
Do we have like an intro or a bio or anything for Andrew? Or
well, that's a great question. I mean, I was gonna say, you know, back when we talked, I guess that was 2014. So actually, we were in our first year of this show, and we're almost 10 years in. So it was back then that we knew a little bit about you. But I remember first time I ever saw you talk, you had this goal of hitting, I think it was 50 doors. I think that was part of your goal at the time. Maybe if I'm thinking about this right. And I know you've far surpassed that. And so why don't you just give us a quick background on maybe why 50 was the target back then, and a little brief, you know, what has, you know, propelled you past that to this point?
Oh, yeah, sure. Boy, it's hard to remember what goals I did have, but yeah, when back then that made sense. I was probably looking either 50 doors or 50 properties. Today, through, you know, raising funds with joint venture partners and that, almost 1,000, right? And it's about 200 million in assets, like holdings. So it's a much bigger machine nowadays. In the last few years, we've focused on property management and renovation as well. So we have 3 property management offices, each with you know, renovation location, stuff like that. Staff of something like 30 people. So it's quite different than last time I was here, which is great. You know, we're always looking to build and stuff like that. We've got some goals that we're still working on. So trying to you know, still grow the portfolio and grow the property management business, which hopefully is based on all the properties I own. Mm-hmm. Right? But we do third-party stuff in it as well. So for me, it's transition's been basically, I was very successful doing 2 to 4 units, and then really, you know, got to the point where I had about 125, 150 2 to 4 unit properties I was holding. Comes with a lot of logistics problems. And a lot of changes in the mortgage industry in the last, say, 5-ish years that made us drift towards buying apartment buildings. So that's what we focus on now. Right.
And, you know, Andrew's like, so, you know, thinking about who our audience is, right? Like, there's not many people that can sort of, well, not wrap their head around it, but understand how you got to where you guys are right now. And so I think that for us, we're going to have to try to focus on, you know, what does that, how do you build something like this? Right. So, and Andrew's brain works a lot differently than a lot of people that I know, because I mean, I'll sit and have a conversation with them, and, you know, I'll have maybe a little bit of a problem or an issue that I'm trying to work through. And he's just, well, he'll give me these brilliant ideas that take like, you know, sort of like a half an hour of explanation in order for me to understand them, just because, you know, he's got these different strategies that a lot of people, like very creative strategies, I guess, in most cases, that a lot of people aren't utilizing. And I know back in the day, you were really good at getting vendor take-back mortgages in Ontario, when a lot of people would say, well, that just doesn't happen here.
Yeah. Actually, matter of fact, I just ran my my last seminar was Saturday that just passed on vendor take-backs. First time we did it in about 5 years. And the reason we did it again, because the market has now transitioned back to sellers being willing to take vendor take-backs. You know, this is something that happens in more of a buyer's market, right? So, you know, We used to do a lot of them on 2 to 4 units. You usually can't get them on single family homes, but we were doing a lot of them before. And then there was a decent enough spread between cap rates and interest rates that you didn't need to do a VTB to, be creative and stuff like that. Although we did the odd one here and there, but now it's our main focus, and it seems to be popular again because everybody's worried about loan to values. But
so very low level, can you sort of walk people through this idea and how it works?
Yeah, sure. Most people think it's so complicated, but really a vendor take back mortgage is just the seller acting as a lender, just similar to a bank would. So either in the first position or the second position. Most of the time it's the second position. And what we do is we look to, right now, given the interest rate environment, we look to use vendor take backs in the second position to increase the total loan to value we can get on a purchase, and hopefully reduce the average interest rate that we're going to pay for the mortgages to help, help keep the loan to value high. Okay. And I mean, there's a bit of a, it takes me a whole day to like run through the seminar and stuff like that, but there's a bit of details and education and things to go, like tricks and stuff to go along with it. But at the end of the day, it's just about trying to create the best financing options, especially if there's you're talking about properties that have, say, issues that may impact financing, like building conditions, especially like foundation, things like that, low rent rolls, or low vacancy, low occupancy, so high vacancy, and also low rental rates compared to market, when the seller still wants a premium for their building, when you look at the fact from NOI, net operating income, and a capitalization rate. So it's a great strategy, and it really allowed me to stretch dollars to build my portfolio.
So like for someone looking at, let's just say, doing this on a duplex, so someone's interested in buying a duplex. So the seller has to be kind of in the right position, because like Andrew, most of the people that are listening to this are usually like people just starting out, right? Mm-hmm. So we're going to get into the transition, and we really want to hear about, these bigger deals that you're doing and stuff like that. But first off, let's just like go back to, let's say someone wants to buy a duplex and people, and so what position would that seller have to be in order to even like entertain the whole idea of the vendor take back mortgage?
So most of the time you're going to get a second mortgage, and that is because most of the time sellers have some type of mortgage on their property already. So when they sell it to you, they need to discharge their mortgage or two, and they don't have enough equity to a satisfactory level to the buyer to hold a first mortgage. So what I used to do, and still do, it makes sense, is, you go to look to get a small portion of financing. So it might be anywhere from, say, 10 to 20, maybe 25 for the second position, to top out at like 80 or 90% loan to value. So if you were doing a duplex, you're probably going to top out at 80%. Although there are times when we might arrange for seller financing to go on after closing, to get our loan to value up to like 90. In the past, I've even done over 100, right? It just depends on the project. And I would say I do get the benefit of being well known. So people, they trust, if I'm going to do a project, that they'll go to a higher loan to value, knowing it's me and my experience. But in general, I mean, if you can try and get something to 80%, especially in today's interest rate environment, I think that's a good transaction.
So doing this through the years and building up your portfolio, at what point did you decide, okay, I'm ready to do this full time?
Actually, I lost my job. I got downsized in 2009. At that time, I had been investing for maybe like a year and a half. I had a few single family homes where I live in Wasaga Beach. And so I was just, the way I got into the business was an agent suggested that I don't sell. My wife at the time, I was moving up to Wasaga Beach. I sold my house in Orangeville. She had a house in Wasaga. Neither house was big enough for a blended family. So instead of selling her house that she had, the agent said, well, why don't you rent it out? So I kind of, sat down, did the math, and like, wow, this is fantastic. And so I started buying single family homes. Back then you get 5% down, even got one with 100% financing, and wasn't too concerned about cash flow or anything like that. So I made lots of mistakes, didn't know anybody, but, it worked out well. And about a year and a half after starting to buy them, I lost my job and didn't want to go back to the corporate world and the long commute, because I live kind of, north of the GTA. And decided that I'd give the real estate thing a shot and started raising funds. And I thought I had a horrible year the following year, only buying 3 properties. So worked really hard. And I do things that when I'm consulting with coaching people, I don't suggest they do, but I did it. Like I worked doing renovations for free. I managed for free, and it made the numbers look better. It helped me gain credibility. I made a lot of equity. So did I work for free? No, I didn't get an hourly wage at the time I was doing the work, but I made a lot of money. So it all worked out well. And being downsized was the best thing that ever happened to me.
And I think if you talk to anybody, who's had a little bit of experience with real estate investing, there's going to be something that they've done that they will tell somebody else, hey, don't do what I did.
Oh, for sure.
And if you don't have that story, then I don't know. Then you're like this. You're the unicorn. Call us up. Let us know. Let us know your story if you've never had any problems.
Yeah, I would say if you're not making mistakes, you're not challenging yourself enough.
Exactly.
I love when the story starts with a setback, because most people would see that as a big setback, right? I got downsized or whatever, losing their job of some sort, and you can go 2 paths with that, right? You can turn that into like oh my gosh, my life's over, or you can turn it into, okay, fresh beginning. Let's see what I can do with this, and go have some fun in something that worked out. I'm guessing worked out probably a little better than you would have thought the job path was going.
Yeah, it's funny, I was a director for a large company globally, right? And I remember my wife at the time said to me, you seem much happier doing this real estate thing. Just keep doing that. So I'm like, okay, well, I guess that's support from her.
Yeah. Really. That's important.
Yeah.
So you mentioned that you raised some money there in the early going, at least, and probably still now, but how did you start that out? Because a lot of people that I know listen to us are always having that question of how do they start raising money and build up that confidence or credibility or all these things so that they can actually go do that. And you said you did that right away.
Yeah.
That sounds like for only a few properties.
I mean, it's funny. My first investor was a neighbor. And I remember I had a Super Bowl party with my agent at the time in attendance. And we were talking about some of the stuff I did. And I didn't know for a little while that one of the guys, my neighbor, was at the Super Bowl party, went and bought a couple of properties after hearing me talk about it. Then he came to me and said that he likes the real estate thing, but he was a police detective with a couple of young children, wife working. He says, I just don't have time for this. Can I just, give you the money and we'll do the investing? And I said, I'm like, sure. Works out great, right? And then when you start getting success or, people know what you're doing without trying to be, oh, here's that guy that coming again. He's going to talk about nothing but real estate. People notice. And the next thing you know, one of the guys, another police officer contacts me. And then the agent that was showing me some properties, he wanted to invest with me. And then it just kind of snowballs, right? And you just talk to people. I did a few things, try and do some podcasts, I wrote some articles for a couple of websites, things like that. I've been in a few magazines. So your name gets out there. And, I always thought myself as a horrible salesperson, especially, coming from the logistics side of corporate. And people tell me all the time I'm a great salesperson, but I think it's only when I'm talking about real estate. So my passion my passion for real estate helps, bring people on, and, they see the excitement and the success I had. And it just, it helps to build it. But the number one thing is, don't be ashamed to tell people, what you're doing about real estate. It's not bragging, right? I guess, to a certain extent, it's not bragging, right? And people want to share in the success with you, right? And if you can get even 1 or 2 properties under your belt, by yourself, it's a great starting off point, because most people, they don't have any rental properties. They have no idea, right? So, even someone with 2 or 3 is a fantastic success, right? And, in the position, in my opinion, to attract people's funds. And the other thing I had was I had great transferable skills, right? So I would talk to people about how I used to manage we did just in Canada, we did over 100 million. And, I managed the customer service and the logistics and the purchasing and all this stuff. And a lot of people have transferable skills, whether it be like public relations and dealing with tenants and stuff like that. So, there's lots of ways to build credibility and start raising funds. And most important, get to some meetings.
Yeah. Go to some real estate meetup groups.
Yeah.
Okay. I know that this is not really like a question that there's a 100% answer to, but let's just say, because we get this question all the time, like, what does a joint venture deal look like? But if you were going to give your best sort of advice on what that would look like, and I mean, I guess it's hard because like everyone's situation is different. Maybe you don't have money to put into it, and then you can't really say, oh, well, then the best way to go into it is 50-50, split the money. So, but anyway, your best advice for someone that wants to get into joint venture deals, how does someone structure that so that it's attractive?
Well, usually the case is someone is bringing something to the table that the other party doesn't have. And so often it would be, someone might have experience or the desire to deal with properties or property managers or even tenants directly. And someone might have cash. Okay. Number one thing is, regardless how great your friendship is, family members, whatever, get an agreement in writing. I hear about stories all the time where, me and my brother invested, or me and my neighbor invested, and we're supposed to do it 50-50, and there's no agreement. Be honest with yourself. Like, you might not want somebody who says yes to everything you suggest, stuff like that. And you want someone that maybe help you grow. So someone maybe that could challenge you a little bit and have, high expectations, so you perform well. But I mean, nowadays, one of our constraints is, like, I have great deal flow. So my constraint is usually capital. Okay. So usually I'm looking for partners with capital. And I know a lot of people, they might split capital, raising requirements or something like that. But if you're looking for, if you're looking to do properties and stuff like that, you're probably the joint venture experience person, right? And you're maybe not raising or putting in any cash. And just look for money it's not their last dollars, so they're not going to be hounding you how the investment's going. It's someone that, in a guy scenario, I'd say someone you would sit down and have a beer with, right? And that's probably going to be a good indication. And someone whose goals and timelines are aligned with yours, right? Most of the stuff you can work your way through if there's other challenges, right? But just common ground, common goals, and you'll do well.
And put it in writing. Like people again, like there's the whole idea that is offensive in some way to, especially if you're talking to a friend, right? But it's very important.
So, I always say, sometimes a contract is not to, figure things out or deal with disputes, because even if, something could be in writing, you can deal with a dispute and go against what's in the contract if everybody agrees. But sometimes it's also, what if one of the persons dies and someone now inherits their portion of the estate and things like that, and there's no written agreement, right? A prenup is not necessarily for the person you're marrying, it's maybe to protect you from, or, part of your family from your wife's, new wife's children or grandchildren or whatever, for coming after things, right? It's not always to protect the two partners. It's sometimes to protect what happens after one partner, say, passes away. Okay? Mm-hmm. And, if you're new at doing, say, real estate and joint ventures and stuff like that, and you might get into a scenario where, we get a lot of staff turnover at property management companies, right? It's just it's a very challenging position. They can be receive abuse and stuff like that from tenants. And someone might be, supposed to be the expert here and, dealing with tenants and managing the property, never done it before, a year in and now bails. Well, what's the repercussions? There should be some repercussions, right? If it's not in writing, what's going to happen? Mm-hmm. It's set up for failure.
So I agree with all those for sure. Writing, not raising someone's last dollar, not taking someone's last dollar. I've experienced that personally. I brought not their last dollar, but they might have had only they were giving me 100K and they only had 150. That's the ratio's a little off there. I want someone to be totally comfortable giving you the money, and then they're just going to be a lot easier to work with because they're not going to hound you over little tiny things. And
especially now, like we're doing apartment buildings. They're 5-10 year terms, right? I believe it or not, I've bought probably close to 200 properties, never done a flip.
Right? Really? Wow.
Interesting.
Most people have that flip.
Not an intentional flip.
Not an intentional flip. I don't think I've sold a property for the first 18 months that I've held it.
Any intentional flips that I've done, I always ask myself why I did that later on.
Yeah. You guys know Ian Zabel. I remember Zabel does great flips, stuff like that. And one day he just couldn't believe how much money he lost by not holding on to those properties.
Right. At least for a little while at the time.
Yeah.
So you just mentioned apartment buildings again. Sandy had said that when you were on last time, you had this goal of 50 properties, and you mentioned that once you got to a certain level, it was very hard to manage all of those properties. So go from where you were to the point where you decided, okay, something needs to change because the scale has just gotten too big to manage.
Yeah. I mean, the funny thing is I sold off a few in hopes of getting down in numbers. And then I just ended up buying apartment buildings to replace them. Right. Mm-hmm. So I've dropped a little bit. I mean, I'm still over 100 properties, whatever, but 100 separate properties, probably at the time, maybe working with 25 joint venture partners, although we have more now, but 25 individual joint venture partnerships. Like, so you might have one investor that has 2 or 3 houses. So there's an insurance policy, there's 3 roofs, there's 3 furnaces. It just became that it was hard to grow because you have to manage or oversee so many small assets. And so we sold some off. It was great for seed capital to buy more apartment buildings. Got out of some partnerships by selling them off, things like that. And just realized that economies of scale, right? It's so true what people say. I'd rather have 20 units under one roof with one boiler, one property management statement, things like that. It's just so much easier. And it just came to the point where I just, I couldn't keep replicating what I was doing and continue to grow the same way because, what was I going to grow to 200, 250 properties, 300, right? It just becomes, way too time consuming and mentally consuming.
So is there a difference between the way you raise money now, or did you talk to some of those partners and say, hey, let's sell off these assets and stay on with us and buy other ones? Or did you is there more of an amalgamation of funds, or how does that work?
It was a combination of both. I mean, I have some investors that necessarily didn't sell anything, that couldn't get any more, 2 to 4 unit properties. So we naturally had to transition into commercial, or which were pretty much multifamily apartment buildings. Some did a little bit, like we sold off a couple, or they freed up more capital and moved it into apartment buildings. And some was, just now prices have changed a lot in 10 years. So what used to be, investment of say 75,000 because we got a VTB on a duplex or something like that we're buying for a few $100,000, now becomes often, a transaction is $1 million investment. I think, one we did, we had to raise, a couple million, 3 million, I think, just for one. Right. And so I still have a good word of mouth and good relationship. Current investors that I have tell other investors. So, there's multiple ways to raise the capital. It wasn't just like, you guys, thanks for buying duplexes with me, see you later. It was a whole combination of things. The other thing is, I have to, I'm not a MIC or a REIT or whatever, right? So I have guidelines that I have to follow, right, as well. So I'm somewhat constrained by those.
Have you ever thought of starting something like that up?
I looked at it. I talked to a few people that own them. They're very costly up front, very heavy management, financial management, for lack of better wording. And I find the returns are a lot less, right? When you have to contribute a lot of money for overhead and stuff like that, it chews up the profits that you can, say, share with your investors.
So the way that you do it now then is more or less just whoever the partner is, or maybe even in some cases multiple partners, they would have a shared ownership in the property.
Often, yeah.
Often, yeah.
Yeah.
Okay.
Yeah.
There's other ways to do it, I guess, just money loans and that type of thing with a certain return.
We don't do those no. Like preferred shares, stuff like that. Most people don't realize that, if you're buying in, say, 4, 5, 6 cap rate area, and interest rates, because you're getting a mortgage, are 3, 4, 5, 6. If you only have like a 2% spread between the interest rate and the cap rate, where's the money coming from to pay an 8% cash on cash preferred share? Basically, the guy that's running the project over-raised money to give back to you, so you get a deferred or preferred payment, monthly, quarterly, or whatever, right? And those projects need to be done usually quickly, because that's not sustainable in a standard buy and hold. Not that we do standard buy and hold. We do cash for keys and drive rents up. But basically what you're doing, you're over-raising and diluting the ROI as a percentage for the investors.
Mm-hmm.
You mentioned cash for keys then. So the strategy is, of course, you buy a building and bring up the value of it in certain ways. One of the best ways to do that is pay somebody to get out of the apartment and renovate it and rent it again for more.
Correct.
Right. How effective is that when you guys are going through and trying to bring up the value?
It's okay. It's never as great as you want, because you never get 100%. But we plan for somewhere, say, 50 to 75% of the units turning over in a, say, 3 to 4 year time frame.
Mm-hmm.
Okay. There's always a few tenants that are never going to take it, no matter what. And we have a strategy, I guess, a formula that we pay based on the cap rate for the area and how much their rent is on the market. So usually we have decent success. Basically, the strategy is, for every $100 per month under market, we will pay $3,000 to $4,000 for the person to leave. So, I know that sounds like a lot, but
So 3,000 to 4,000 for every 100.
Yeah. So if someone was say
very good incentive.
Yeah, it's a whole process, right? We don't run right out in there and tell them the max.
Do you don't wave the cash in their face,
right? Oh, I've personally gone to the door with a big stack of $100 bills, and sometimes that works. But basically, someone's $100 under market, and if you're in a 4 cap rate area and your rent goes up $100, basically, I do a slight adjustment on the net operating income increase to account for increased costs in property management and vacancy, because those are based on a percentage of rent collection or rent roll. But basically, it's about $27,000. So I always just round down to $25,000 for every $100. So why wouldn't I give someone $3,000 to leave if my building value is going to go up?
Right.
Now, we usually don't do it for $100, but 200, 250. We've got some that are like 800, right? If you're in a 5 cap rate area, it's about $18,000, right? So you might give someone $3,000 and it goes up 18,000, right? So it's really great way to drive value regardless of the market condition. Okay. We have a whole process and a strategy of how much we'll overpay for a building based on being able to do cash for keys. Then we have I've called it the logistics of making the offers, and you don't run out and offer the guy with the guy that's 800 under market. You don't go to him first. You go to the people that are 200 under market, right? Stuff like that.
More likely that they're going to agree to it, right? When they're 200.
Yeah, because if you go to the 800 guy first and he takes 15,000 to leave, and he tells the guy who's 300 on the market, you got 15,000. Guess what your number for the 300 guy is going to be? Somewhere around 15,000, right?
Right.
Yeah.
So, but it works really well.
That's what's great about those properties, right? It's more of a math thing than it is the smaller 2-4 units, that sort of thing is a lot more challenging to come up with those equations, because it's kind of a lot more of a variable, right? At least that's my thoughts. And then this just becomes a math thing. You said 18 to 25,000 in those cases, 5 or 4% cap rate, right? So it's significant lift in those.
It is. And so our strategy nowadays is like we do projects, and yes, the bank's going to make you cash flow based on a debt coverage ratio. I tell investors that we're not doing a cash flow project. We're doing a raise the building value, velocity on our funds, get the funds out. We'll give it back to you in hopes that you're going to reinvest with us again. Mm-hmm. Okay.
And that's, like you said, a 3 to 4 year outlook on that specific building, usually something like that.
Yeah. It's like when I produce numbers, if I'm evaluating a building and I'm, thinking about buying, usually, we're talking, but the minimum is pretty much like 12 units, right? We prefer probably like 20 to 30 unit buildings, right? Although I think the largest one we have is 94, but we're looking for, say, 10-year project, and to keep things simple and easy and, add a little bit of buffer. I look to refinance exactly at the 5-year time frame. That's how I run my numbers. And our goal is to get in position to be able to refinance in 3 to 4 years. So in 3 to 4 years, then, if I get it done in 3 to 4 years and my numbers were based on 5, I'm going to be delivering a much higher ROI on that investment than I originally had planned. Mm-hmm. Right.
And so the expectations of the investors investing with you, given those timelines, is essentially no cash flow for that time frame, but big lift at the refinance point and probably at the 10-year whenever you end up potentially selling the property, right?
Not always. Not always. I mean, often we'll intend to pay cash flow after say 12 to 18 months.
Right. Okay.
But what ends up happening is, when I'm trying to do the numbers for a project, I need to try and estimate how much funds I need to have up front for cash for keys, how much I need for renovations. And I'll be honest, we don't do major renovations. Like, we're not looking to upgrade buildings. Basically, we'll fix what needs to be fixed, and we'll get the units re-rentable, but we're not going to be doing like upgrades and stuff. You're like
not
that.
Full gut.
No,
every unit.
No. And then, so, it's a trade-off. If I know that, I think I can get the rent roll up. Say we start with a rent roll of 10,000. I think we can get it up to say 15,000. I may not want to raise all the renovation funds. I might want to, let's say I'm going to need 200,000. I might want to raise 150 because I know in say years 2 and 3, I'm going to have extra cash flow because I've repositioned the rent roll. And if I raise less funds, I offer a better ROI for investors overall, right? So, what we'll do is, let's say it's going to produce, I don't know, easy math, $10,000 a year in cash flow from year 1. Well, in year 2, we'll start paying $10,000. In year 3, we're probably still paying $10,000. In year 4, we're probably still paying $10,000, right? And the difference, the spread that we've grown is going to go back into trying to get more tenants to leave and stuff like that, more payments, right? Mm-hmm. And then, like I said, it's all about, for me, it's all about velocity on money. Get the money into the project, get it out as fast as possible. So now hopefully we have infinite return. Right.
Yeah, those are some great tidbits there. Thanks for sharing.
Yeah.
And it's like, and that's why people ask me, why don't I go to a higher cap rate area like Alberta or the US? I'm like, well, I want to drive up building values in the lowest cap rate area I can, which is Ontario, and the ability to get buildings with severely under market rents doesn't exist in non-rent controlled areas, right? So for me, Ontario makes perfect sense, right? When you look at it from that formula point of view.
Wow, that's a good one. There's sometimes we take little clips from this and share them around, and that little 20 seconds there, I haven't heard someone as an advocate for Ontario in a while.
Mark that down.
That's the only thing. That's the only thing.
I don't think you'd be hard pressed to find a building full of under market rents in the States either, though, or in Alberta,
But so the buildings that you find in certain areas, they probably are buildings that need like a lot of renovations and an upgrade, right?
Yeah, it's not because of that it's under market here.
Yeah. I had one feedback from one possible investor located in BC and said my numbers were fantasy. He didn't understand the project. He says you can't renovate 18 units for that amount of money, do all the common areas, the roof, and I'm like, where did it say we were doing that? Right. We do.
A lot of people are doing that. A lot of people are doing that. That's a good mindset shift that you don't necessarily need to do that to that level to upgrade. That's the thing with Ontario. There's a lot of people that they stay in these units for a long time, so the rents get pretty low, and the rental rates have been booming for a while.
Yeah.
So there's a big spread there, right?
Yeah.
Without even renovating, just doing the cash for keys concept.
Yeah, and just freshen up, maybe paint a couple of doorknobs, maybe occasionally do the flooring, like nothing major, right?
What's you talked about raising the income here? Any key things you look for in the other side of things and lowering the expenses on these buildings?
I know a lot of people are on about separating utilities and stuff like that. We don't necessarily worry too much about that. I mean, obviously you pay a higher rent rate if it's inclusive, but we will look at certain things. Can we operate better, right? Better, like say, contracts for garbage removal, snow clearing. One of the benefits we do have is since we manage and usually clean and renovate probably 95% of the properties we own, we're able to make sure that we get some efficiencies with making sure the staff are doing what they're supposed to be doing, keeping an eye on the workers and stuff like that, and we're able to control schedules for renovations and stuff like that. So effort to reduce vacancies and things. But I mean, I'm more focused on growing the income. I know like for every dollar I save in a building is equal to the valuation of the building is similar to raising the rent $1. But I think there's a lot more opportunity to raise rents, and it's usually not seen as a negative thing or trying to make too many changes, as opposed to, say, coming in and clamping down on expenses and,
right,
small things, right?
I mean, it's easier to do that than figure out who leaves their lights on and air conditioner on all day long.
Yeah, like if I challenge my team, let's either get, just for round numbers, $5,000 in additional NOI per month, right? So, are they going to spend all kinds of time looking for $5,000 in probably impossible savings from cutting expenses, or are they going to go out and they're going to try and turn over the rent roll, pay cash for keys, maybe add some services or whatever, or laundry or whatever, to drive that up, right? To me, it's focused on the income side, right? You want to totally ignore the expenses, right? Like you can do like water saver kits and, motion sensor lights and stuff like that. But, you only have so much, because we have a lot of projects on the go, we can only commit so much time. I'd rather focus on income growth, right? Than worry about cutting the expenses a little bit.
Now, often the income growth is pretty obvious. If there's obvious expenses, then I'm sure you probably tackle them. But if they're kind of, you're trying to hunt down a needle in a haystack, I mean, what's the point? Focus on what is there to improve and go for it, right? And makes sense.
So, I'm sure you're going to be able to answer this in like 30 seconds. No problem. But when you're looking at these buildings, how do you evaluate them as something you could potentially want to buy? Go.
So I would say that most of the time I look at just the numbers on paper and then decide to buy. Okay. And basically is, the key components are, what is the cap rate? What is the interest rate? How much is the market rents? Or how much is the rent roll under market? I run my numbers, and then most people know that I have a saying: if I think I can make 30% per year on average, then I'll look at buying that building. Right? Okay, simple as that. Right?
So it's actually not that difficult.
It's not that difficult. Like, I mean, I do coaching consulting for people, and they tell me about their transactions, and like, why are you way over there and say, Windsor or outside of Ottawa or whatever? Oh, because the building was for sale. I thought it was a great deal. Just focus on the main thing. Pick a strategy, couple of metrics to measure it, stick to a particular area and just focus on that, right? People think that they have to run around trying to find buildings. No, you can commit in time and find ways to find buildings in the area you select.
And so what area what area are you in?
Our main focus is the 401 corridor east of, I guess, from like Ajax out towards Kingston, probably. We actually have a couple of properties in Cornwall that we have to, at this point, have someone manage for us. But from Ajax to Kingston, we're buying. That's our main target area. And we also do like Simcoe County. Just bought a couple apartment buildings outside of Barrie, right? Working on a couple more. So those are the two areas that we focus on most, right? That's that. 99% of my properties would be in those areas.
And so other than Cornwall, it's all managed by your team.
Pretty much. Yeah. Yeah. I do. To be honest, I do have one third-party manager in Kingston, and he did a good job before I set up my own office, that I didn't want to punish him by taking the stuff back. So I thought, you know what, I'm very, very high on ethics. You did a good job for me, did cash for keys for me. And I didn't want to say, oh, I'm here now, got my own office, give me my stuff back. So he still manages it for me.
That's great. Yeah. So without, getting too personal, what does the portfolio look like?
I think I mentioned earlier, it was like, we're getting close to 1,000 units, about 200 million. I've been doing it for a long time. So, and we've got a lot of growth, both from transactions and from value increases, like doing our own, cash for keys and stuff like that. It really helps drive building value up. And just, open up our third property management office in Oshawa a couple months ago, and hopefully open up another office in the next year or so in Trenton Belfair area. And we'll see how it goes from there. But, obviously, I don't need to buy any property. People remind me of that all the time. I hear all the time, hey, Andrew, don't you have enough? I love what I do, so we'll see where it goes. But
okay. Man, I just, I'm very impressed like super impressed. And it seems like almost every day, well, let's say almost every month, it seems to me like I'll go onto social media and see, oh, Andrew's got a new building under contract.
Yeah, you know what? It's not quite as much as we used to. Interest rates have impacted us. So, I I know this, I'm going to sound like a complete jackass saying this, but I said to a few people, I might have a disappointing year and not buying 100 units this year. Right. So we're a little bit slower right now. To be honest, I mean, there's a lot of fear in the market and people are hesitant. Right. But, I'm out there every day. This is what I love to do. So every day I'm trying to buy stuff and,
Are you seeing more fear in investors to invest in with you, or are you seeing more fear? Just what's your take on generally kind of where we're at now? Where does that fear lie? And is there maybe a time coming where there's going to be an influx of deals out there potentially, or any thoughts on that?
Well, there's a lot of people sitting on capital. They're not sure what's going to happen. Like if you look at some of the market stats, even for single family and small duplexes and stuff like that, once the Bank of Canada didn't have a rate increase for 2 months or 2 or 3 months straight there, you would see that, and there's always supply issues, right? You would see that prices were starting to go back up. Multiple offers were going back up, and the days on market were dropping, right? And then, so, people were talking again. Now we've gone back to 2 more rate increases. And it seems like everybody's, those are the ones that were thinking about moving to do something are probably, hesitant again now, right? Sit in line, see what happens. The other thing is, in the commercial world, if you get CMHC insured mortgages, they're not as high as people think they are, but the cap rates are still pretty low, right? Often sellers are asking less than, when you look at what they're asking as a cap rate, they're offering their property at a cap rate that's lower than the interest rate. So technically, if I'm paying 4 cap rate and my interest rate is 5, I'm actually losing money, right? So it's harder to get some transactions done, and the spread or the ROIs that we're able to obtain have decreased a little bit, still within our standards, but it's just a matter of time. I think the rates will go down, maybe in a year or so, right? The inflation number was good the other day, so it'll balance out at some point. But what I'm trying to do is just try and do a few transactions to keep growing, but much more selective on what I would do given the interest rate environment.
Mm-hmm.
Makes sense. So it's an interesting time with the economy, that's for sure. Lots of fear out there.
I hope you're right.
Right. The rates are gonna go down, right? People are gonna have to invest. You don't necessarily change everybody's mindset. They might pause temporarily, but it'll come back.
So as much as you love what you're doing and the day-to-day may be reward in itself, what on top of that are some of the things that motivate you? Like, what things give you inspiration, drive to keep going? I know you mentioned before we started recording that you'd been taking a lot of amazing vacations and able to see some places. So, what outside things, I guess, are drivers for you?
The big benefit of what I do is because of my staff and things like that, and I have a business partner who does like boots on the ground. I only need an internet connection to do what I do. It's pretty much mostly done on the phone, internet. Occasionally I do some face-to-face meetings with individuals. It's nice to be able to help people. I don't need to buy any more real estate, but it's satisfying to, accomplish something, get something under control. It's great to give money back to investors and they retain their ownership. That's a great feeling, right? Gotta be honest, I don't have enough hobbies, right? Yeah, I like to travel, but if I'm not doing real estate, I don't know what I'm going to be doing.
Well, you mentioned you were hiking in Panama, things like that. I mean,
yeah, but you can only do so much of that. And it's just, it's hard to fill 16 hours a day.
Well, I think that's the goal for everybody, right? Like that's the ultimate goal from real estate is we all want more freedom from it. Right. And
Absolutely.
so if we're able to accomplish that, anywhere near the scale that you've been able to do it, then I think we're winning. That's for sure.
Yeah. You know what? I'm very blessed. I have the freedom of time, you call it financial freedom. So I'm very blessed that way. I worked very hard, probably too hard, didn't delegate enough growing the business. So I don't want to say I paid the price, but I did, I had many 80 or 100-hour work weeks several years ago to make, to get me to where I am today.
Mm-hmm. Well, I don't know, Andrew. I obviously very, very impressed with what you guys have built. And thank you for coming on and sharing all this with us. I know that there's sort of just scratching the tip of what knowledge that you have. But if anyone listening out there is interested in what Andrew's doing and want to learn more, how could they reach out to you?
You can just get in touch with me, Andrew at palmtreecapital.ca.
I like that. Palm Tree Capital. That's great.
Yeah, you can probably guess where I was sitting when I.
Just like coconut hit you in the head, and you looked up and went, Palm Tree Capital.
Yeah.
That's it.
No, the coconut didn't hit me, but I was struggling for a name. It was like, this is my favorite spot. I'll pick this. So, and a property management company called Shoreline. All right.
Okay, gotcha. I like it.
Sticking with the theme.
Beautiful. And okay, so Palm Tree Capital.
Yeah, Andrew at Palm Tree Capital, or you can just go on our website, palmtreecapital.ca.
Okay, got it. Anyone who didn't catch that or wants to just check it, go into the show notes, and we'll have Andrew's contact information in there, and you can reach out to him. And thank you, man. Thank you so much for coming back on again. It's been way too long.
Yes, I hope to see you again soon down where you are in Costa Rica. So
yeah, come on down anytime.
Yeah.
Well, I'll welcome you in.
I haven't crossed paths with Sandy for a long time, but you said you have a thing in Vaughan.
Yeah, you should come out sometime. Vaughan Investors Club. Well, we should have you out sometime to share with our audience. It's right at Vaughan Mills, right in that near the mall there.
Can you send me some details?
Yeah, I'll float them over to you.
I wouldn't mind coming out sometime.
Yeah, you guys have been having a big turnout there, right? Like it's been doing well, right?
It's been awesome. Yeah, I mean, you can't get a more accessible location really in the GTA. I don't think, where it's like all the highways come together and you can come from anywhere, north, south. Well, yeah, north, south, east, west, and kind of hit it pretty easily within half hour or so for a lot of people. So it's been a great time. Great time getting in person again. We had the coming off COVID stuff. It was like, can we get in person and make this like start from scratch again, or is that like a thing of the past? And it's been great.
People still stand 10 feet apart from each other to have their conversation, or
6 feet.
Yeah, honestly, it was that was one of our limiting beliefs probably around that was just like, are people going to actually come to these things still? Right. And I kept seeing, obviously, Durham REI, we've always talked about in the show, and been a great leader in that space. They, I think they're still getting 100-ish people every time. Or like, I think if they can do it, I think out there all the way to wherever it is, Ajax, Whitby, wherever they're doing them these days, we can get them to just north of Toronto. I think it's possible.
Well, Vaughan is half the distance for me. It's going to Quinton's meeting. Right. So
there you go. Yeah, it's good. We will make sure we get the info at VaughanInvestorsClub.com for anyone else that wants to find that. And we'll make sure we get you on the list there, Andrew.
Okay.
But other than the Investor Club, Sandy, how do people get in touch with you?
Social media anywhere. I'm pretty out there on those channels, or Sandy at freedomreps.com.
And people can reach me at rob@mrbreakthrough.ca. Thank you again, everybody, for listening, and we'll see you next time.
Thank you, guys.
Thanks.